Hello, I'm Himanshu from RealAsset Edge. Today I'll walk you through my single tenant industrial acquisition model and show you how I built a decision ready dashboard right starting from the assumptions tab. Okay, let's look at the overall model structure first. The model is divided into three different sections. The blue tabs act as the input tabs. These are the only tabs where you'll enter the inputs. The green tabs are the calculation engine, which provide certain schedules or the calculation to reach the final cash flow and a debt schedule. And finally, there is the output dashboard with all the KPI tiles listing the key stats and a little more detail about each of the stats down below with the pricing matrix at the bottom. Now let's start looking at the assumptions first. This is the assumption section where you start by entering general property information, the property size, date of analysis, some market related information like the inflation rate, market and inflation and general vacancy, moving to valuation inputs, uh, purchase details, and debt details. Now, you provide all these details over here on the assumptions tab. This gets linked all through the model, and there is no repeat input required for these. On the right hand side of this tab, you see a sensitivity analysis. This is essentially the output of the model for the return analysis, but it shows a sensitivity on various scenarios of purchase price and exit cap. Moving to the rent roll tab, now this is a very important tab for the model, which includes a rent roll for the property. Now we have a single tenant called new distribution company. We require the square footage, lease start, lease end dates, what is the current contract rent, and any leasing related information for this tenant. Now, this date could also be in the future. It need not be already commenced lease. It could be a future dated lease as well. Now, just below this, you have all the market leasing assumptions, which are related to the space, and a blended calculation based on the renewal probability. This blended calculation will be used throughout the model for calculation and not the original new lease or renewal lease inputs. Down below, you have a property rent schedule, which has all the key line items starting from potential base rent, uh, scheduled base rent, expense reimbursement, and the TILC linked with this space. Now, this section of this model is essentially getting calculated from a different working tab, which is called tenant cash flow. The tenant cash flow tab breaks down the whole tenant cash flow into monthly level detail. You have the first section which calculates the current contract, the first contract detail that you entered on the rent roll tab on the in the top section. This is the contract section of this model, which calculates all the base rent, free rent, what should be the current contract rent based on the escalations that are noted in the model, if there is any free rent which is currently due for this lease, uh, what would be the expense reimbursement, TI and LC in case this is a future dated lease. You would see that in this section. Just below this, we calculate the market term. The market term is coming from the market leasing assumptions, and the same calculation happens for this term as well. You see this blanks because this is the current contract. If you scroll to the right and scroll enough to the right, you'll see a market period where the market lease is getting calculated. Down below, there is a section to calculate the leasing commissions for the market lease. And then this consolidates into the suite level cash flow for this particular suite, which is listed on the top. Now, essentially, this whole cash flow can be repeated for other tenants as multiple tenants as well. Uh, right now, this is configured for one single tenant, but if the need be, it can be configured for multiple tenants using the same structure, same repetition of the same lines once again. Now, moving back to the rent roll, this whole schedule from the monthly cash flow, monthly tenant cash flow, gets rolled up into the rent roll tab into clear yearly cash flow for the space. This is going to be used in the operating performer further. The operating performer is the overall performer, including the operating expenses. I'll get to that in a second. Before getting there, let me get to the expense schedule. The expense schedule uses the inputs from the user for all the expense line items that are required for the model. There is also a line item for capital improvement plan in case this property requires a couple of years of renovation in the start and then a lease start in year 3. You could configure that lease start in the rent roll and then use these two sections, these two cells to actually input the capital expense that is needed for the first 2 years. Or if there is no such expense, you can leave it blank. Once the expense schedule is created, this then rolls up into the operating performer, which is formed using these two tabs, the rent roll and the expense schedule. This is the Argus style operating statement, uh, use, which is built starting from potential base rent, uh, and all the absorption turnover vacancy calculations were there in the rent roll schedule, uh, moving up to potential gross income. Then the vacancy and credit loss allowance is required to be calculated. This there is special care done to this specific section that we do not double count the vacancy loss for the property. So you'll notice that there is no vacancy loss for the years where there is absorption and turnover vacancy and free rent from the property. So economic vacancy is above the market vacancy in these 2 years. Therefore, there is no vacancy loss seen here. If you move down, the real estate tax, insurance, common area maintenance, all of these expenses are directly pulled in from the expense schedule. However, the management fee gets calculated based on a circular reference. The circular reference is because the expense recoveries include the management fee, and the management fee includes the EGI after expense recoveries, so which creates a circular reference. Now, there are multiple ways to solve this circular. One of the ways is that you go to the options, go to the formula section, and enable iterative calculation. Now, if you know that there is only one circular reference in this model, which can be explained, you could use this option right now, which is the simplest way to implement this. Now, if there are other ways as well, one is through a macro where we could have a supporting line item and a button to calculate management fee each time we change an input, or a goal seek function to enable the calculation of management fee once an input is changed. In this model, we've used the iterative calculation. Now, moving ahead, you'll see that all the tenant improvement allowance and leasing commissions were rolled up from the rent roll section, and the capital expense and the capital reserve were rolled up from the expense schedule to get the property level cash flow before debt. This schedule is the property level and is therefore created for all the 11 years. In the next schedule, this is the financing cash flow, which summarizes the property operations on the top and then also layers in the debt service required for the property to calculate cash flow after debt service. So there is the next section, which is on the unlevered cash flow, which starts from the property purchase price, closing cost, and then also the receipt of gross sales and selling cost in the disposition year to calculate an unlevered cash on cash return and unlevered IRR and equity multiples right here. The next section is a levered cash flow. Here, the loan proceeds are included in the cash flow. You see an acquisition loan proceed and the loan fees, which would be paid in the start, and then the loan payoff, which is the ending balance of the loan at the end of the hold period. Now, this hold period is dynamic. You could change this going back to the assumptions. If I just add maybe a 5-year hold and I'll come back here to the financing cash flow, you will see that the hold is reduced to 5 years with the other years not used in the analysis. All the formulas and calculations are now based on these 5 years of cash. Let me change this back to 10 for now. Moving ahead, the next tab is a debt schedule. This is a dedicated tab to understand the debt cash flow of the property. You see an amortization schedule on the top, and then calculation of all the debt metrics which are related to DSCR, the debt yield, and loan to value. Here you also see the outstanding loan balance at the end of the maturity of this loan. Now, next tab is actually a supporting tab so that I can have all the KPIs which are required to be displayed on the dashboard KPI cards. These KPI cards are dynamically updated based on any number change that happened in the model. Uh, Here I've included the purchase price, loan amount, going in cap, and the equity needed, and all the return metrics which are unlevered IRR, levered IRR, and equity multiples and equity profit on the property. Next, we have the operating summary of the property, which shows the occupancy details. Uh, Compare the average contract rent with the market rent over here. Then you have all the loan details along with the loan stats, the LTVs, DSCR, and debt yield, the reversion statistics, sources and uses. And down below, you see a detailed pricing matrix, which is a sensitivity analysis of changes in price and changes in exit cap. How much impact does it have on the IRR and equity multiples or the cash on cash returns? Now, this is one example, a sample of the model. I prepare many such custom models. If you'd like help customizing this structure for your own industrial or logistic underwriting, or want fractional modeling support for your team, any analyst bandwidth that is required, feel free to reach out to me via LinkedIn. Thank you.